Alright, dear friends, as you know, indicators always hold a special place in technical analysis. Even if you don't trust them entirely, you can still use them for better confirmations. Indicators are generally divided into several categories, such as volume indicators or oscillators, also known as oscillating indicators. I've already covered everything you need to know about indicators in detail in a previous video. If you haven't watched it yet, I highly recommend checking it out because you'll gain valuable insights from it. There's another category called trend indicators, and one of the foundational indicators, often referred to as the mother of all indicators, falls under this category. It's none other than the moving average. In this video, we'll explore what a moving average is, how it works, what it's used for, the different types it has, and the differences between these types. Stay with me as I explain everything you need to know about moving averages. Moving averages essentially take the average of prices and a series of data points, filter out the fluctuations, and display it as a smooth, even line. However, keep in mind that this indicator doesn't predict the future direction of the market. It only shows the current direction and is considered a lagging indicator. I mentioned earlier that it's called the foundational indicator or the mother of all indicators. That's because it serves as the basis for many other indicators, such as the MACD and Bollinger Bands. The main purpose of moving averages is to identify trend direction and determine support and resistance levels. Moving averages also come in various types, but two of them are used more frequently, which I'll explain to you in detail. Alright guys, you can easily find the moving average on all brokers' platforms. Here I'm using the quotex broker interface, which is currently considered one of the best options among binary brokers. If you're interested in trading on this broker, you can sign up through the link provided in the description and make deposits easily. I've already introduced and explained how to deposit funds in 2 previous videos. Now, if you're working on quotex, you can go to the indicators section and click on moving average. Let's start by reviewing the first type. As you can see, this top section where it says 10 indicates the period of the indicator. We won't focus on that for now, but I'll explain what it means and how it works later on. If you click on the lower section, it shows you the different types of moving averages. As you can see, there are 5 different types here, but depending on the broker, you may see fewer or slightly different options. But the 2 types I mentioned are the most commonly used, and we want to focus on them and get more familiar with them. The first one is SMA, simple moving average, and the second one is EMA. Let's stick with the SMA for now, and I'll explain everything about it, as well as what EMA is, and the exact differences between them, and why EMA was created in the first place. So, SMA stands for simple moving average. The formula for calculating this type of moving average is the simplest way to calculate an average. What does that mean? It takes the number of periods you've set in the settings. Like in this example, we've selected 10 and adds up the prices within this specific range, then divides by the total number of periods. So here it adds up the prices for the last 10 candles and divides by 10. This is the simplest way of taking an average. We specify the period and it sums up the prices over that range. If we change the period from 10 to, for example, 50, you can see the shape changes. It now sums up the prices of the last 50 candles and divides by 50, which is the period we selected. This is the simplest method possible, and it's exactly how we would calculate any average. Now, despite being very useful, this type of moving average has received a lot of criticism. These issues led to the creation of another type of moving average, the EMA, which I'll explain to you now. Let me switch it over. Pay attention to the moving average line. When we switch from SMA to EMA, its position slightly changes. See how the shape and form of our moving average line have shifted a bit? In the previous state, which was SMA, there was no differentiation between prices from earlier periods. Let me explain more clearly with an example so you can better understand what I mean. Let's say we set an SMA with a period of 100 on a daily time frame. Imagine that our time frame is daily, meaning each of these candles represents one day. Now suppose we set a 50 period or 100 period moving average. Let's assume that on the first day, meaning we're looking at the first of the 100 candles, the price of the asset or the chart we've chosen is $100. Now after 100 days or 100 candles, it reaches $300. What does that mean? It means that the price has increased by $200 over these 100 days, from $100 to $300. Now keep this example in mind. Let's imagine the opposite scenario. On the first day, the price is $300, but by the 100th day, it has dropped to $100. For example, let's say it dropped down to $100 here. How would that look? It's the exact opposite of the previous scenario, which means we've seen a $200 decrease in price. But the problem is that in both cases, the SMA remains the same and shows no difference. That's because the SMA's calculation method is simply to add up the prices and divide by the number of periods, without considering any differences between the prices of today and the prices of 100 days ago. As a result, its shape doesn't change, and it looks the same in both scenarios I mentioned. This can cause issues for traders, which is why another type of moving average was developed, called the EMA, exponential moving average, which you're looking at now. The EMA was designed to address this problem. The EMA focuses more on recent prices and provides quicker signal outputs. It assigns a greater weight to more recent candles compared to older ones. For example, if we set the period to 200, it doesn't just add up the prices of all 200 candles and divide by 200. Instead, it uses a specific formula that gives more emphasis to recent candles, those closer to the current time, and less emphasis to older ones. In other words, it weights recent candles differently, making the EMA more responsive to recent price changes, and thus more effective for traders looking for quicker signals. So using the EMA gives us somewhat better results. This is how they solve the issue with the simple moving average. Now let's talk about the period setting for these moving averages. Many people, including some of my friends, ask me, what is the best setting for the period? There's no such thing as better or worse. It entirely depends on how you want to use it and your strategy. It varies based on what you want to understand and what your goal is. For example, a trader who trades on higher time frames, such as in Forex, will have different settings compared to someone trading binary options. However, some of the most popular period settings for moving averages are 10, 20, 50, 100, and 200. Each of these can provide us with different insights. There are also some traders who have a particular interest in Fibonacci numbers and believe that using Fibonacci numbers for selecting the period of the moving average can yield good results. It ultimately depends on your preference, and you can test them out to see what works best for you. Now let's discuss a technique known as the moving average compression rule, though I should note that this technique isn't very useful for binary options trading. It's more suitable for Forex trading. This technique requires using 8 to 10 moving averages with different periods, starting from the smallest to the largest. I'm going to add 10 moving averages here, starting with a period of 10 and increasing from there. I'll then explain how this technique works and what we expect to happen to the chart. It should take on a particular shape. Let me add these moving averages with different colors, and I'll speed up the video a bit so as not to take too much of your time. I'll start with the first one using a period of 10 in red, and then move on to the next one. Alright dear friends, as you can see, I've added 10 moving averages with different periods and different colors to the chart. Now the chart looks quite cluttered, but let me expand the video so it's easier to see. Let's go back a bit. As you can see, there are certain areas on our chart where all these moving averages have come close together or overlapped, and they've become intertwined in some way, like here. They are so close that some of them are practically overlapping and compressed, like a spring that's been compressed. Whenever we see such a scenario, we expect a strong upward or downward trend to form afterward. You see, this happened here, and suddenly we observe that this spring has been released and a strong uptrend has formed. However, we cannot predict whether the trend will be upward or downward. But in areas where we see this kind of compression in the moving averages, we expect a powerful trend, either bullish or bearish, to form. This means that after it breaks out of this compressed state, we have to wait and see in which direction the trend is moving. Once it breaks out of this state, you'll notice, for example, that as the candles move past this point, the lines start to spread out, indicating that a strong upward trend has formed and the market has moved up significantly. Now, it's also possible that after such a scenario, we may see a very strong downward trend. It's not guaranteed that it will always be an upward trend. But in any case, whether it's bullish or bearish, we can expect a powerful trend to follow in the market wherever we see such compression. So let's quickly review the key points I discussed in this video regarding moving averages. The first point is that moving averages are calculated based on past data, so they don't have strong predictive power for the future. That's the first point. The second point is that moving averages work best when the market has a clear and defined trend. However, when there's a lot of volatility or choppiness, their performance is not as effective. The next point is that you should use other tools alongside moving averages, as they are not sufficient on their own. But despite all the pros and cons we discussed, just like any other indicator, oscillator, or tool we use for analysis, moving averages have their own strengths and weaknesses. If we consider all these aspects, moving averages can be highly useful for us and can always help us in trend identification and analysis. I hope you enjoyed watching this video, and I hope I was able to share information that's beneficial for you and helps you improve your trading process. I hope I was able to take a positive step in enhancing your trading journey. If you are satisfied with this video, be sure to like it and write your opinion in the comments. I will be happy to know your opinion.
Dear friends, to make sure you don't miss any of our videos, please subscribe to the BS Academy channel. Also, activate the notification bell so that you are informed as soon as we publish new videos. Thank you for your support.